This poker chip represents a single share of a company, and here are 100 shares of that company. Well, let's say you decide that their business model seems pretty solid, so you buy those 100 shares for 20 bucks. Great, these shares are now yours, and in fact, most people would probably be done here, but you don't have to be. Instead, you can capitalize on owning these 100 shares and sell a call against them. That means writing a call option, creating an entirely new contract, and selling it for cold, hard cash. That money is now yours, and you can spend it however you want. Well, there's two possibilities after this point. One is that the call option expires out of the money. You keep your premium, you keep your shares, you're just a little better off than when you started. The second possible outcome is that the stock price rises, assuming you sold out of the money option, and it expires in the money. The call option buyer then exercises that option, buying 100 shares at the strike price. Sure, you do lose your shares, but you get to keep the premium for selling the call, and you also make money for selling those shares at a higher price than you bought them for. Well, I don't think that analogy is going to carry you through to actually trading these suckers, so let's go into more detail on how they work, their pros and cons and all that jazz, and then we'll do a trade on Thinkorswim, which is TD Ameritrade's trading platform, so you guys can actually see how they work in real life as well. All right, let's start building our covered call position here. So the first step is buying 100 shares. So here we have 100 shares of AMD. Now what we're going to use these 100 shares as is collateral to write a call. Now, if you're not familiar with writing calls or even what that means, I'm not surprised because most people spend a lot of time just buying calls and puts. Writing a call is selling a call you don't already own. This creates an entirely new contract and it sells it to somebody else. So what is your obligation as a seller? Well, if you think about when you buy a call, you get the right to exercise it, meaning you buy 100 shares at the strike price. So when you sell a call to somebody, you have to provide those 100 shares if they decide to exercise. If that call gets in the money and your counterparty exercises, you have to fork up those 100 shares and toss into their lap. And that's why we have these 100 shares here. And it'll kind of make sense as we keep going. So let's say we sell a call. Its strike is 55. So it's an out of the money call. And we receive 50 cents premium in credit. That credit you get to keep. Because you don't ever have to buy back to close this position, either it expires out of the money and you would keep the credit anyway, or it expires in the money, you get assigned, meaning that your counterparty exercises, and those 100 shares get called away from you and go to the buyer of the option. But either way, whether you get assigned, meaning the buyer exercises, or if this call expires out of the money, either way, you get to keep that 50-cent credit. Now, you could buy to close this position, but that's not really the point of a covered call. So when you sell this and you get that 50 bucks, you can do whatever you want with it. You have that 50 bucks now. That's really cool. You can make money off the 100 shares you already own just by selling a call against it, and you can withdraw it and buy a pack of beer if you want. That's basically it. That's basically a covered call. But let's walk through in more detail the benefits and risks of this kind of trade. So let's draw out a little stock chart here. This is AMD. So we'll say it starts out like this. So we buy 100 shares at 50. And we sell a call with a strike of 55. Let's think about our possible outcomes. The first outcome is that the stock price goes down. As the stock price goes down and we hit our expiration day, let's say expiration is right here. This call expires out of the money. It no longer exists. That premium stays in your pocket. The trade's over. You still have your 100 shares. The only thing that's changed is that you've collected $50, which has really overall reduced the cost of these 100 shares. So if we bought 100 at 50, what we paid is $5,000 for those shares. But since we made $50 from selling this call, we get to subtract that. And now the cost of these shares really is more like $4,950. So we've reduced what's called our cost basis and made these shares cheaper. Of course, we're still incurring losses. Owning 100 shares and riding this wave down is going to overall incur us some losses. Our delta is positive still. So if the stock price goes down, we are losing money. But we're going to lose money anyway if we're happy holding this as a long-term position. We've only reduced our losses and reduced the cost of our shares. So that's one possibility. The second outcome is that the stock price rises and it goes above our strike and our call expires in the money. So if our call expires in the money, we have to sell 100 shares at the strike price. So if the strike is 55, we have to sell 100 at 55. But if we bought 100 at 50, we make a net gain of $500. So let's write it out here. We bought 100 shares at $50 per share. Then we sold 100 shares because we were assigned at expiration day because our call was in the money at the strike price of 55. So really we are long $5,000 worth of stock, but then we get to sell that for $5,500. So this would be a debit and then a credit. So we get a net credit of $500. So we still made money on the trade, but not only that, we also got to keep our credit. That doesn't disappear. You sold that option, it stays in your pocket regardless of if the person exercises or whatever happens. As long as you don't buy to close that call, you get to keep that credit. So yeah, we make $500, but we also make $50 on top of that. So we make $550. So what's the downside here, Adam? Well, in our first example, the stock price went down. If you don't like holding this underlying stock, that's going to stink. If you don't believe that's going to rise in the future again, in the long term, that's going to stink holding 100 shares as things go down. But if you're comfortable holding them, you get to make $50 just selling a call against it if you're going to hold it for the long term anyway. So no downside there, really, if you're comfortable holding for the long term. In this example, where our call expires in the money, what's the downside here? The only downside is that we miss out on this extra return. Since we have to sell it at 55, maybe the stock price went all the way up to 60 at expiration, we miss out on that extra $5 and we lose those shares. These 100 shares get called away. We have a flat position here. So we have 0 shares, but we made $550. It's a big zero, dude. It's a fat goose egg. So if you really, really, really wanted to hold those shares, then you're going to be kind of bummed about that. You missed out on some opportunity for capital gains because things went higher than your strike. And that's why when you open a covered call position, wherever you sell the call at, you need to be comfortable letting that call, your shares go at that strike price. But at the end of things, either way, you're making money, basically. Sure, in the last example, you technically lose money because the stock price depreciates in value. But if you're going to hold it for the long term anyway, you don't really care. So you made $50 on top of it just for owning those 100 shares. In this case, sure, things went above your strike and you maybe missed out on some capital gains, but you still made $550, which is not a loss. So to summarize, our two outcomes are the call expires out of the money. You get to keep your shares and the credit. Our other option is our call expires in the money. We lose our shares, but we get to make the difference between these two prices, which was our $500, plus the credit we received. So both ways, if you're comfortable holding for the long term and comfortable selling at your strike, regardless of what way the stock price goes, then it's kind of a win-win situation. This is a sketch of what your profit and loss would look like as a profit loss diagram. So you lose money if things go all the way down, you make money as things go up, but you stop making money once the stock price passes your strike. So remember, on the x-axis, we have the stock price. On the y-axis, we have profit and loss. If things go past your strike, that's when your profits stop because you're going to have to sell those shares at the strike. Now, you could buy to close your call, but it can get kind of expensive. So generally, you want to be sure that you're comfortable selling those shares at the strike price. Now, how do you decide which strike to sell at? Well, it kind of depends on how badly you want to keep the shares and how much premium you want to receive. So if you really like holding AMD, you can sell a pretty far out of the money call that's very unlikely to get in the money and therefore unlikely for you to get assigned. But you're going to receive a smaller premium because the further out of the money, the less those options are worth. Now, if you don't really want to hold the shares that badly, like you're okay letting go at a price a little bit lower, well, you can use it as a way to exit your position by selling a call that's a little closer to around at the money. And if things go down and you're okay with that, well, you get to keep the larger premium, the larger credit, because you sold a call that was worth more. So it's pretty subjective. As long as you're okay with holding the shares for the longer term, and you're also okay with the potential of having to sell those shares at the strike price, then you're Gucci. There's nothing that can really hurt you. There's no surprise. Oh, and one more thing about this here graph. This is all at expiration. So before expiration, if the stock price is going up like this past your strike, you're going to see that your call is losing a ton of money. Like you'll see it shows that your profit and loss is pretty hurty. But once that call expires and it gets assigned, all that really ends up happening is you stopped making money past your strike. So if you see that your call is losing a ton of money, don't panic. That's fine. At expiration, it's going to get assigned if it's in the money. Roger, got it? Cool. All right. Let's run through an example on Thinkorswim. So we're on Thinkorswim, and we're going to use their on-demand feature, which allows us to trade in the past, which is pretty neat. And I know their platform's kind of sandpaper on the eyeballs, but if you get used to it, it has a lot of cool features. Plus, TD Ameritrade has a bunch of free educational content on their website, and you can access it by just creating an account with them. I found it really helpful. You can learn about futures, fundamentals, options, all sorts of different stuff and it'll quiz you and stuff like that. And I found that the actual quality of the educational content is really solid. I'm not sponsored by them. I really appreciate what they're doing. I think you guys might find that helpful. Okay, so we're trading in the past here, and we're trading on AMD again. This is in March 1st, 2018, back when AMD was trading at 1184. If I go over to the monitor tab, this is where I'd see all my positions. We have no positions. I've reset this on-demand account. So let's go ahead and buy 100 shares of AMD. Our quantity is 100 up here. We hit buy market. We can send it off. What are we buying it at? We'll find out here in a second, I guess. So we bought 100 at 1185. Now we want to sell a call against it. Let's say we think things are going down. So let's sell a call against our 100 shares. So we're going to go over to the trade tab. And I know this is just so hard to look at, especially if you've never used this platform, but I'm going to try to direct your attention to the important stuff as best as possible. So right here in the middle, we have our strikes. So 5 through 21. These are our strikes. Going down, going up as we go down, of course, because why make trading easy? And then our expiration is the 16th of March, which is a couple weeks away. So let's say we think that let's go to the 4-hour chart here. Let's think that we see that the trend is changing. Let's say we think over the couple weeks, things are not going to be looking so good. Maybe semiconductors are not doing well because of some news or whatever. And we want to hedge our position and sell a covered call. So we go to trade. Let's go ahead and sell. We can sell a 13 strike for 19 bucks, roughly $17 to $18. Which means that we don't expect the stock price to go past there. Now, if it goes past there, we have to be comfortable letting go of our shares at $13, which is not going to be that big of a deal because we got in at $11.82. We make roughly $1.20 on each of those 100 shares, making roughly $120 if things bump up there. So we still make money. But if we're wanting to hold this for the long term, best case scenario is that we just hedge our position and we collect a credit on our long-term position. So let's sell that 13 strike call. And you can do this on Robinhood too. You can do it on any platform. The method is the same. It's just the UI that looks different. So we have our 13 strike call. We're gonna click on sell, make sure that we're just selling one. And we want it to get filled immediately, let's say, so we're gonna sell it for the natural of 17 cents. So we're gonna collect a 17-cent premium, meaning we get $17 credited to our account. And we get to keep that. We can go spend it if we want. So we'll hit confirm and send. There we go. So now under this AMD, we have both our 100 shares and our call that we sold. So let's fast forward a little bit to the day of expiration and see how things are looking. So we're going to pop forward to, when does this expire? March 16th. Okay, so now we're on March 16th. This is the day our option expires. We are a couple hours away from closing bell because I believe this is Pacific Standard Time. So we've successfully stayed below the strike of the call we sold. And if we go over to monitor, you can see we've collected quite a bit of money, almost our entire premium of the call we sold. We've collected $17.50 and we sold it for 18 cents. So while overall you can see that our position, you can see the profit loss open is minus $20. We've lost $20 overall because the stock price has gone down from our entry point. But we've negated some of those losses by collecting $17.50 of premium. And now this call is going to expire worthless at the end of this trading day. And we don't have to buy to close. We don't have to give up our shares. We just earned $18 against the shares we already owned. So let's go ahead and fast forward to the opening bell of the following day and see that our option no longer is there and we're going to be left with our 100 shares. Okay, well, this platform is saying that we still own it. Technically, it would have expired already. You can see it has -3 days to expiration. That's what days means right there. So we have -3. It's not processing it correctly. But we've collected a credit against the shares we already own. Now, if things popped up and we had to sell it at the strike, they would be gone, but we would still make a profit, the difference between our entry point of the shares and the strike price of our call times 100. That's why covered calls are just so scrumptious. Like there's like why you can't be mad. If you're mad when you're trading covered calls, you goofed. It means you sold an in the money call trying to collect a big credit, but then had to sell the shares at a price lower than you bought them for. Or if you didn't want to sell the shares at the strike at all, no matter what the strike is, and it becomes in the money, and you want to buy to close the call and you have to pay a big amount of money, which would incur a loss to close that call, then that's a problem. But if you're comfortable holding shares as things go down or selling at the strike if things go up, you can't lose. Thanks for watching, guys. If you have any questions about this, let me know in the comments, hit me up in the Discord, whatever. I'm happy to answer questions about this. Have a lovely day. Thanks for watching. I'll catch you in the next one.